Hi, I'm Omar Murillo. I'm the founder of Imperial Wealth Advisors and a certified financial planner. If you've ever sold an investment with a gain, whether it's a stock, real estate, or even your business, you've likely felt the sting of capital gains taxes. For high earners, that tax hit can exceed 30% when you factor in federal, state, and net investment income taxes. But what if I told you that under current law, there are strategies that could potentially reduce, defer, or even eliminate your capital gains taxes altogether? No gimmicks, no magic loopholes, just careful planning using tools written directly into the tax code. In this video, I'll walk you through the 3 proven strategies that, when implemented correctly and on time, could save you hundreds of thousands of dollars in taxes. Strategy number 1, strategic portfolio restructuring. Let's start there. This isn't about picking winning stocks. It's about structuring your portfolio to be tax efficient. How, you might ask? 1, tax loss harvesting. Selling investments that are down in value to offset gains elsewhere in your portfolio. Just be mindful of the IRS wash sale rules, which require a 30-day window before buying back a substantially identical investment. 2, asset location. Placing tax inefficient assets like high turnover funds inside IRAs or Roth accounts while keeping more tax efficient assets such as municipal bonds in taxable accounts. 3, timing gains with lower income years or combining them with large deductions like charitable giving. For instance, funding a donor advised fund during a high income year can create a powerful deduction that offsets gains. Here's a hypothetical example. A business owner has $250,000 in unrealized gains. By selling underperforming positions to harvest $50,000 in losses and donating $150,000 to a donor advised fund, they could generate a $55,000 deduction, reducing their taxable gain and saving over $100,000 in taxes. Now, here's an important note. These are hypothetical examples and they're here for illustrative purposes only, and results will vary based on your individual circumstances. Now, let's move on to the second strategy. And this is especially relevant if you own real estate. Delaware Statutory Trust 1031 exchanges. Section 1031 of the Internal Revenue Code allows you to defer capital gains when you sell an investment property, provided that you reinvest the proceeds into a like-kind property. One increasingly popular option is using Delaware Statutory Trusts, or DSTs. DSTs allow fractional ownership in institutional-grade real estate without the headaches of being a landlord. They offer diversification, passive income, and estate planning benefits like a potential step up in basis at death. However, 1031 exchanges are time sensitive. You must identify your replacement property within 45 days and close within 180 days. A qualified intermediary must handle the exchange process. DSTs also carry drawbacks. There's limited control, illiquidity, and potentially higher fees. They're not right for everyone and should only be pursued with proper legal and tax counsel. So here's a hypothetical example. A dental practice owner sells a commercial property for just over $1 million. They had an original cost basis of $600,000, so they're facing a $400,000 capital gain. By completing a 1031 exchange into a Delaware Statutory Trust, they are able to defer the entire tax bill and potentially pass the assets to their heirs with a stepped-up basis upon death, erasing the deferred gain entirely. Again, this is a hypothetical under current tax law, not a guarantee. Strategy number 3, qualified opportunity zone investments, or better known as QOZs. These were created to spur investment in economically distressed communities, and in return, they offer meaningful tax benefits. You defer your capital gain until the end of 2026. There's potential tax-free growth if you hold the investment for 10 years or more, and the opportunity to invest in impactful real estate or business projects is there also. But make no mistakes, QOZs are not for everyone. They require a long-term commitment, can be illiquid, and often concentrate risk in specific geographic regions. You must invest within 180 days of realizing a gain, and you'll need to hold the investment for a decade to realize the full tax-free benefit. Here's a hypothetical example. An entrepreneur realizes a $1.2 million capital gain after a liquidity event. She invests the proceeds into a qualified opportunity zone fund focused on multifamily housing. Her gains are deferred, and if held for 10 plus years, future appreciation may be entirely tax-free. Now, the key here is combining strategies. Here's where it gets powerful. These strategies don't have to be used in isolation. A well-structured plan might combine tax loss harvesting with a 1031 exchange, or pair a qualified opportunity zone fund investment with charitable giving. And when coordinated with retirement and estate strategies, the impact can be substantial. But timing is everything. These strategies must often be implemented before the sale of an appreciated asset. And once the transaction is complete, many of your planning opportunities simply vanish. So these are re-established ways to reduce or potentially eliminate capital gains taxes: strategic portfolio restructuring, Delaware statutory trust 1031 exchanges, and qualified opportunity zone fund investment. None of these strategies are one size fits all, and they all require careful consideration between financial, tax, and legal advisors. If you're planning a major sale or have already realized significant gains, it's worth a conversation. Click the link below to schedule a strategy call with my team, and let's explore what may be possible in your situation. Thank you for watching. If you found this valuable, please share with someone you think will find it valuable as well, and follow us for more insights tailored to high net worth investors like yourself.